Well, good evening, everyone. This is AJ Monty. It is 8 o'clock on the nose, and we are about to get started here with our monthly open house Q&A session. Let me get rid of the market guy screen here so you can see what's behind there, kind of like a curtain. I just opened up the chart of the VIX. For those of you who are joining us for the first time, what I normally do is I go through a market analysis including the VIX and some of the other major indices, and then we get into some discussions around your positions. And please understand this is an open house, interactive Q&A session. So the question box that you have at the bottom of your screen there is for you to use, and you can respond to comments that I make, or if you have a question, put that in there. If you have a specific position that you want me to talk about, like Bruce does with his Netflix position, then put that in, and we'll be sure to cover that. This is your chance to connect with me in a way that you're not normally able to connect through the alert service. And again, if you're new, this monthly web presentation is really for the benefit of the members who subscribe to the Oracle services. It's an added value service that we added to the mix and to the schedule so that you can get more in-depth analysis of what's going on. Now, I'm going to start with the VIX, and if you notice this line at the bottom of the chart, let me go down here and get rid of that. Okay, that support level for the VIX is right around 1182, just below $12. And if I back up on the weekly chart of the VIX, you can see that that's a pretty significant support level there that's holding. And we really want to pay attention to that because, remember, the VIX is a contrarian indicator to the S&P. So if the VIX is bouncing for over a year now, bouncing off of that support level, then it means that the S&P is at highs and could potentially pull back. Why is this not a guarantee that it'll pull back? Because the VIX is an oscillator, and we might have a spike in volume and then have it come right back down to support. But you'll notice that on the upside here, we have a resistance area on the VIX that really keeps this in a channel. From 12 to roughly 22 is the range for the VIX. And if you go back and highlight, let's say the VIX here is what I'm going to say that high on the VIX was 2148. That was on February 3rd. You could see that prior to reaching a high, the VIX started its rally in the middle of January. Now let's go to the S&P so you can see how this compares. Remember, the middle of January is when the VIX started to bounce off of the support level, and you can see here the middle of January right here is when we hit the high, and shortly after that we had a bearish engulfing pattern. Now it doesn't look like much on the S&P, but the S&P dropped from 185 and then it hit a low to around 174. So that was a significant sell-off during those 3 weeks. And remember, we got the lead indication from the VIX when it started to bounce off of these lows right here. Let me go back a little bit further to show you the monthly chart of the VIX. Now, this is a 20-year monthly chart of the VIX. And let me get rid of all my lines so that I can draw a 20-year support level for you. Just going to draw a horizontal price level there. If I go back all the way to 1994 and I drop my line right there, there it is. That's a 20-year support level for the VIX. And in the past 20 years, we know from history that the VIX has rallied from that point. And in 2007, we had the greatest rally when in 2008 the market started to sell off. But look, we had a bullish engulfing pattern. I'll zoom in here for you. We had a bullish engulfing pattern in 2007, right there on a monthly chart. Now remember, that bullish engulfing pattern showed up long before the 2008 crash. And for all of 2008 and even into the beginning of 2009, we had one of the most dramatic sell-offs that we've seen in our lifetime. And it all started with a bullish engulfing pattern on the VIX in February 1st of 2007, long before this major rally. And then, look, interestingly enough, we had a series of bullish engulfing patterns that continued the show. Here's one that started it. Here's a second one. Here's a third one. Here's a fourth one. And then here's the big granddaddy fifth one that ultimately, in the middle of 2008, we had that major spike in the VIX all the way up to 90. So why am I showing you this? Because it's important. It's something that most people tend to ignore, or they think maybe it's just for option traders, or it's something I don't need to pay attention to. But whether you're trading options or not, the VIX is something you need to pay attention to. And we are at, again, these 20-year support levels, and it's one of the reasons I keep waving the caution flag, because that's my job. My role is to educate people in the area of risk management so that you're not going to suffer a catastrophic loss. Now, in the meantime, the markets are rallying. How is that possible? Well, in the alerts that I put out, you may have seen that I have been using the word manipulation. I do believe that the Federal Reserve is manipulating the markets. They continue to pump money by printing it. And you and I both know that if we were to set up a printing press in our garages somewhere and print US dollars, we would be arrested and imprisoned for a very long time. But the Federal Reserve, which is not a government agency, a lot of people think it is, it's a private agency that controls our money. They are keeping the printing presses running. And with that money, they are supporting the stock market. And eventually this has to break. Eventually we have to see downturns. We have to see stops being triggered. We have to see inflation. Eventually we have to see interest rates go up. And when interest rates start to go up, that's going to be the beginning of what I think is going to be the most significant sell-off that we've seen that could potentially dwarf what we saw in 2008. Now, for some of you hearing those words, you might get a little nervous. And I could understand that, because we tend to fear the things we don't understand. But to put your mind at ease and to relax you a bit, also understand that in 2008, right here, when the VIX was hitting its highest levels, there was lots of money to be made. Lots of money. As the markets continue to go down, there's ways to short the market. There's ways to trade options in the market. There's ways to make money in contrarian bear funds, or even gold and silver that tend to work opposite of the Dow when we start correcting. So there's lots of ways to make money. You just have to start focusing on that, because we have plenty of time to be able to prepare for a downturn. And when that time comes, you should be very quick to get out of any long positions and quickly jumping into these other commodities and instruments that will allow us to make money when the market turns down. Okay, now let me go through the rest of my analysis. You could see that I'll go back to a daily chart here, and I'm going to go into the SPY because it's connected to the VIX, and there it is. Now, in the weekly market report that I put out on Saturday, I did mention that we are at resistance highs, and we are making an attempt to retest those highs. And I did mention that we could probably see higher levels in the beginning of the week to retest those highs, maybe fill the gap that was right there. Today, actually, I think we filled that gap. Let me move my control panel over. Did we fill that gap? There's a little gap right there. Let's see, that low was 188.79. So if the high was higher than that low, we filled the gap, and the high is 188.74. So was at 5 cents away from filling that gap. Now, once the gap fills, here's a test question. Hopefully you could interact with me at this point. Who's going to be the first to answer this question? When gaps fill, what generally happens 80% of the time after the gap fills? Who wants to answer that? You don't feel pressured. If you feel like answering, go right ahead. Robert says it drops. That's right. If this gap fills, there's an 80% chance that the spiders will drop. And if it's a downward gap, and again, I'm talking right now about a gap that was left above the market. George, you're correct. Goes down. Bruce, you're right. It goes down. If a downward gap is filled, there's an 80% chance that once that gap fills, the stock is going to reverse. So keep that in mind. So that's the spiders right there. Now, if I jump over to the diamonds, remember the Dow 30, it's only 30 stocks that we're tracking. The S&P is 500 stocks that we're tracking, so the Dow is a narrower index. I also mentioned that we could possibly go up to retest the highs right here, and I think that we're still on pace to try to do this. Oh, I drew my timeline. I got to get rid of that. Hold on. I didn't mean to do that. Hold on. Bear with me. There we go. I'm going to draw a trend line here. So what I think could happen is we can go up, test this resistance before going lower. That's what I think is going to happen. So why do I think that we could drop from after a short rally? Because if you look at the volume down below, look at the past 3 days. The volume is down, which means that the sellers are resting. When a stock is going down and you see the volume drop, it means the sellers are getting a little tired. So I think the buyers will come in, and then the buyers will get a little tired after they hit resistance and come back down. So the volume is a big leading indicator for me as well. Let's go to the Russell 2000. Russell 2000, out of all of the indices, is what's really catching my eye and what's in most trouble right now, because as I mentioned in the weekly market report, we are seeing lower highs. These lower highs are being followed by lower lows. You see that? So we are in a very well-defined trading channel that's now broken down below the 200 period moving average. The 200-day moving average is the most significant moving average, especially when we are in May. The mutual fund managers, and I mentioned a little bit about this in the report, mutual fund managers, many of them now, have no choice but to get out of their positions when their funds or their stocks within the fund start to drop below the 200 period moving average. Not all funds, don't misread this, but the majority now that are coming out, the newer funds, have, if you open them up and look at the prospectus, many of them have a risk management plan built into the funds. And so by prospectus, they are required to get out when their positions start closing below the 200 period moving average. Now, the Russell 2000 is the only index right now that is below the 200 period moving average. Going back to the diamonds, you could see that here's the 200 period moving average. If this line extends and we continue to go down and we break below that 200 period moving average, all bets are off now. Now you have a complex head and shoulders pattern that's breaking down below necklines, below moving averages, and the tide will shift very quickly. So these are things that you need to watch out for, along with the VIX and along with volume. Price and volume are the major leading indicators, bar none. And you don't want to get caught into reading oscillators and all these Fibonacci numbers if you're using it just to back up your opinion. Price and volume is the most important. Okay, let's go to the Qs, and then we're going to wrap things up here with the analysis, of course. Now, look at the Qs. The Qs are at a major triangle resistance area. Here's the triangle. I don't know if you could see this. So we're at the apex right now. We are at a point where a breakout here could cause the Nasdaq to rally. So out of all the ones that are pointed out right now, the Nasdaq actually looks the most attractive. So if you are still shopping for a long position and we have not yet broken down below the moving averages, the Nasdaq market is where you should be shopping. We're going to be talking about a lot of Nasdaq stocks here tonight because we have positions in them. But the Nasdaq is where you should be shopping. Technically, this looks pretty bullish because of the most recent candle. I would like to see that in higher volume, but the most recent candle is a long candle that almost broke out over that resistance today. It almost closed over that. So tomorrow, if we break out of that triangle, you could very well see another rally to the highs from back in early March. So keep that in mind. If you're going to shop NASDAQ. Don't go into the Russell 2000 stocks. Try not to get into the Dow stocks if you can help it. S&P, you can look at some of those. But the Nasdaq looks pretty good right now, at least for now. Okay, now that's my analysis. Now, as I promised, a couple of people have some positions, and Bruce, I didn't see your answer. I had oh, there it is. I see it. Okay, so Bruce, and for those of you who are not option traders, just bear with me because this is an explanation of a position that Bruce has. Bruce is long Netflix calls. NFLX is the ticker symbol. He is long the January 330 calls. And the reason he is long the calls is because, well, number one, if he was to buy Netflix outright, it would cost him almost $365 a share. So it's pretty expensive. So Bruce got long. Bruce, I hope you're okay with my talking about this. It's going to help you as well. Bruce bought the 330 calls, which act like the stock, but they're a lot cheaper than the stock. So he bought the 330 calls. Stock has gone up. He's making money on that. And going back to Bruce's position, he's long the 330 calls. Now, if any of you have done a buy right, this is where you buy the stock and you sell a call against it. That's a pretty basic option strategy and pretty easy. You don't need any kind of major option clearances. Most brokers will allow most of their clients to get approved for what's called a covered call, where you buy the stock and you sell a call. You buy the stock and you own it, and you sell a call with the promise to sell it if the buyer wants to buy it from you. But in this case, Bruce bought the 330 calls instead of the stock, and then he sold front month calls like a covered call against the long call position. And he sold the 370 calls. So let me describe what this looks like. Okay, here's a line that represents where he's long. He's long the January 330 calls, and he is short the 370 calls. Now, in a position like this, which is called a diagonal counter spread, or if you do a covered call where you buy the stock and sell the call, your most profitable price point is going to be at the strike price that you sell. So Bruce is short the 370s, and this is exactly where you want the stock to go. You want it to stay right around here. Actually, Bruce, you want this stock to go a little bit higher. You want to go about $5.50 higher, and then you are in perfect position. If it goes a little bit higher from there, it's still okay, as long as it doesn't start rallying over 400 to 420. It starts getting up to that range, you have to do something. But right now, there is nothing to do except celebrate your fantastic position right here. So hopefully that's helped you so far. Okay, now what I'd like to discuss is the Apple position. This is the first time for the option trades. This is the first time where I've had to leave a position open and wait until expiration to see where the stock is closed. Now today the stock was up $7, and we are actually short. We have a position in the Oracle position where we're short the 580s, and we're short the 580s, and we're long the 560s, I believe. So we're out of the money on this one, or actually in the money on this one. And what we want to have happen between now and June expiration is we want Apple to start to come down and fill the gap. if the stock comes down and even makes an attempt to fill this gap over here, anyone who has that short call position is going to be making money. Now, if you did not roll to the June position, then and you took a short Apple position, then buy your Apple position back and then roll back into the short call spread. All right, so that's what you need to do on that if you haven't done it already. From what I understand, most people are in this one and rolled it already. So I'm just making sure that no one got caught on that. If you happen to have gotten caught where you didn't do anything and you wound up short the stock, then please send me an email so I could address that with you. It's a one-time phone call that I'll make out of the mentoring service just to make sure you're not going to get hurt on that. But it still looks good because I'm still bearish on Apple. All right, so watch out on that one. All right, now here's the time now for you to submit your positions. Go right ahead. George has a question on EGLE. That was Eagle Alpha, Eagle bulk shipping. This was a position that we put out on Friday. Now again, today's Monday. I put an alert out to buy EGLE at the market on today's session. So what happened is the stock opened right there at, when did it open? At 327. So it opened only 2 cents higher from where the alert was. If you bought the position, congratulations, you're going to make some money here. If you're like George and you didn't buy the position yet, George, it's still okay to buy this. And here's why it's still okay. Yeah, you're going to pay 30 cents more than those who bought it this morning, but look at the volume. See the volume? You have a beautiful green candle volume with a green candle that closed on the high. How do I know that? Because there's no shadow above the upper candle. See that? This is a day that we just ran out of time. That's all that is. If the market was open till 5 o'clock instead of closing at 4, this stock probably would have been going higher. Now, the first resistance point is going to be right here around 372. Keep that in mind, George. If you buy it right here and it starts turning down from 372, you might want to take a profit. However, if you buy it tomorrow morning and it breaks out over 372, then it's probably going to fill this gap up here, which is the target price that I set for the stock. So you still have a lot of room here, percentage-wise, even if you buy it at 355 and sell it at 410, 415, that's still a great trade because I'm really having some great success with the cheaper stocks, and hence the reason why Nasdaq, through the Qs, is still looking bullish. I'm still finding cheap stocks that are doing well. Here's one last week, or a couple of weeks ago actually, Office Depot, ODP. Look at this one. We bought that back here, I think it was, on this bullish engulfing pattern. Bought this around 4, and these are my step-up points. If you were following the alerts, and you know that we were trailing the stop on this one, here was the first breakout. We moved our stop from down here to up here. The stock broke out again. We moved our stop from here to here. The stock broke out again. It pulled back from, it broke out of resistance, and I got stopped out. I think most others got stopped out. If you did not get stopped out and you're still in this position, you basically got lucky, because look what happened today. There's a hammer pattern here. So this one actually might go a little bit higher, but I would not mess around with this. If you did not get stopped out of this and you're still in it from the lower levels, congratulations, you're making money. But you need to put your stop right below today's low. If this stock starts going down below today's low after a hammer pattern, it's probably going to come right back down to fill that gap and then bounce. So you don't want to give back all that profit. There's a big gap down here that's acting like a vacuum cleaner, trying to suck that price down to fill that gap. So don't mess around with that gap. You have a beautiful profit in this, and you don't want to blow that one. Another one that we got into was Corinthian colleges. This one still looks good at the lower price levels below $1. Here's why. Look at the volume. Price has been going down for 5 days. Volume has dropped today with the doji. This is usually a sign of a pivot point. So if you're brand new and you are not an Oracle subscriber, then you lucked out by being on this one, because here's a great, give you a nice return. You could probably buy this tomorrow for under $1, and I think up here around $1.10, $1.20, you're looking at a really nice 10 to 15% return once that gap fills. I think that cocoa, also known as Corinthian colleges, I think that could easily get back up to fill the gap. And we've been playing this one on the bounces. Even though it's in a downward trend, we've been finding the perfect places to get the bounces and get out with pretty decent profits. Cocoa's a good one. Okay, now, let's see. Gil says THRM. Gil, just as a reminder to everyone as well, if you give me a stock symbol, please let me know what your intentions are or what your position is. In other words, if you give me THRM, tell me I'm thinking about buying it. Does it look good here? Or I own it at, whatever price. So that way I can help you at least manage the risk. So Gil, as I'm looking at this, you intend to buy. Thank you. Okay. So now folks, I don't know what this stock is going to look at. I'm going to pull the chart up, but make sure you have a Word document or a piece of paper handy to write down some of the symbols that come up. So THRM, I typed it in wrong. Okay. Now, this one looks good. And obviously, we've looked at this one before. I wouldn't have had the lines. This is a classic step-up pattern on this stock. And let me draw some new lines and clear this out. Let's start at the very beginning. Let's start a little bit higher. Let's say this resistance high, and I'm going to draw a price level. I'll zoom in a little bit to make it clearer for you. There's a lot of people that still challenge with, hey, where do I draw the horizontal line to mark my roll reversal? Well, it's a general area. Please, some people say, oh, that high looks good, so I'm going to draw my line right there. And then they look and they say, oh, well, that line can't be good because the stock went down below that line here and here. No, that doesn't matter. It really doesn't matter, because resistance and support are general areas. So what I could do is I could maybe take, instead of the tops of the shadows, I might take the body of the candle. Okay? I might take the body. So I'm going to drop the line right there at the top of this red candle body. And now you can see that the bodies are right on that line. So here is resistance. Here is resistance. It broke through resistance here. Now it turns to support here, 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 and here. Okay, what happens up here? Same thing, a general area. There's a step-up pattern. Same thing here. There's a step-up pattern. Now, Gil, if you're thinking about buying this one, there's two places that I would consider that. And let me switch my, let me get rid of these lines now that I've noted this for you. Delete drawing there. I'm just going to clean it up so everyone could see how simple this really is. Now, there's two places I would buy it. Obviously, we have a green candle here on strong volume. So, Gil, what I think is going to happen, now remember, this is recorded. I think this stock is moving for a breakout. Rarely do you see a stock rallying on a resistance point unless the buyers are ready to push it through. And this stock has a history of doing that, pushing through the resistance. So the first place I would buy it is if tomorrow you have a green candle, I would buy it above 41. That's point number one. So Gil, you got that one above the resistance. That's place number one that I would buy it. The only other place would be if the stock pulls back from this resistance, comes down to the roll reversal support, and then pivots up. So this area right here would be the second place that I would buy it. Okay, so hopefully everyone has that. So what you can do on your computer is, and if you don't have time to sit in front of your computer all day, most trading platforms now have what they do is they have alert features where you could have an email sent or a message sent to you if the stock is trading around 38.5. So, Gil, you can do this. Set an alert up for the stock when it's trading 38.5, or set an alert for the stock when it's trading above 41. So, again, if it breaks out tomorrow, buy it. If it pulls back, wait a couple of days and bounces, buy it. Okay, now let's get rid of that. Let me show you how to protect yourself on that. All right, and this part that I'm going to talk to you about is going to be interactive participation by the audience. Let me get rid of that. Delete drawing, and I got to delete drawing. Okay, so I'm making a mess of the thing there. Okay, hold on. Okay, delete drawing. Okay, now everyone, assume that you're Gil, and tomorrow the market's open, and you buy the stock at 41.20. So you buy the stock up here. Where are you going to place your stop? Give me a price, exact price if you can. Okay. And I'm waiting for answers. Okay, Shannon, I got yours, and I'll wait to announce that. I got yours, Bruce. Got yours, Jeff. I got yours, Rick. Okay. Okay, I like your answers. Okay. All right, good. Now, let's go with Shannon's first. Shannon buys this at 41.25. Shannon says, I'm going to put my stop at 37. Now, that's an interesting one, and you could very well do that. That's a very safe place to put your stop. And that's going to require a $4.20 risk per share. Now, Shannon, along with Bruce, says 37.80. Rick says 37.75. Ken says 37. Sheldon says 36.5. Those are all fine. Now, if you're going to allow the stock to drop that far before it gets stopped out, you have two support levels that are defending your position. This one here, because if it breaks out, that turns to support, and this one here, which is already established support. So you have two lines of defense in a position like that, and that would be fine. You're giving the stock more than enough room to trade. You're giving it breathing room, the whole thing. That is fine. I'm okay with that. And that's probably where I would put my stop. Now, some of you put your stop higher, and let's look at that now. Where'd those answers go? Okay, so where was it? Okay, Jeff says going to put his stop at 40. Okay, there's Jeff's stop. Gil says he's going to put his stop at 40.94. So he's going to put a really tight stop there. Now, are both of those stops acceptable? Yes. Gil doesn't want to take a big loss. So he has a smaller risk per share. And then you have Jeff, who wants to give the stock a little bit more breathing room. So he's giving his position a risk per share of $1.20. Remember, that's $1.25. That's assuming we buy it at 41.25. So look at these three stop levels: 40.94, 40, and 37. Here is the interactive question once again. What is the benefit of let's say this. What are the pros and cons of putting your stop so low down here at 37? What's the positive? We mentioned that already. You're giving the stock a lot of room, and you have two lines of defense. But what is the negative aspect of putting your stop so low? Okay. Gil says risking dollars. Okay, Bruce has the right answer. Bruce says you have fewer stocks in the position, and that's right. See, each one of you, if you use the 1% rule correctly, each one of you, if you get stopped out, will only lose 1%. But each and every one of you will have different size positions. Let's assume that everyone has the same number in their account. Let's say each of you have 100,000 in your account. Gil will be able to buy the most shares because he's only allowing a very, very small risk per share. You have Gil down here, on the other hand, has a larger risk per share, so he's going to have to buy less shares. But if all of you get stopped out, you're all going to only lose 1%. And that's the great thing about sizing the position, is that you can absolutely reduce the risk and still make money by trading these even volatile stocks. So again, that looks like a good position. I would have everyone should put this one on the watch list because this one looks pretty good. Now, some words of caution here. Gap, boom, gap down here below the market. See, this is why you cannot hold on to the stock if it starts breaking down below 37, because it could wind up going down to 29 to fill that gap. And it would still be over the 200 period moving average. Look at that. This stock could still be over the 200 period moving average and still drop significantly. So you have to be careful with that one. Okay, I'm going to go and check to see. Diana says BIIB. You're in at $38. Wants to know whether to hold or sell. Okay. Now, Diana, wait a minute. In at 38. You meant 380? No, it can't be 380. Okay, BIIB. Did I type BLLB? No, this is Biogen. BIIB. Diana, do you have the wrong price there? What price do you have? You said $38. Are you really having it at $38? Let's see. Okay, no, you don't have it $38. What is the actual price that you hold it at? You say that you're in on it. Okay, so you're in at $38. Wow, let me go back. That's a tremendous gain. Wow, beautiful. Okay, now on the monthly chart, this looks like sell, 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 sell. But the good thing on the monthly chart is that you have a spinning top here. Now let's go back and narrow this down. Let's analyze this. We're zooming in now. Now remember, Diana has a huge profit. Looking at the weekly chart, I would draw a support level that you would use as a stop loss order. But before I tell you what that is, Diana, please tell me where do you have your stop set? Where do you have a stop loss? Hopefully you're going to have one. If you don't have a stop on that, then I'm going to ban you from the market, guys. No, I'm not going to ban you from the market, guys. But you need to have a stop. I mean, you're up, up almost 1,000% on this thing. Okay, do you have a stop? Diana's not answering me. Hopefully you have a stop. Okay, you have a stop at 270. All right, that's beautiful. Because look, here is where let me get a price level there. That is where I would draw my support level, right there on a weekly chart. And you say you have it at 270, and the support level is at 272. So congratulations, that is where I would put it. Now, some people are saying, "Oh, heck, I would sell it now, and I wouldn't risk, an extra $20 on that." But that's actually the right thing to do, and here's why. Keeping your stop below support is the right thing, but then you have to trail your stop. The key is now, where does Diana trail her stop to? If her stop is down below support and the stock goes up, where should she trail her stop to? All right, now you're getting pretty good as a group. I'm going to ask you right here, is that a resistance level? The answer is yes. Is that a resistance level? The answer is yes. Is that a resistance level? Yes. And then again, yes. So here's, Diana, mark these points if you can. 300, let's put 310 and 317. So 300, 311, and 317. Those are the areas of resistance. So Diana, if you have this stock break out over this area right around 300, then you're going to move your stop from 270 to 290. If the stock continues to go up and now goes to 311 and breaks over that, you're going to move your stop from 290 to maybe 305. And if it keeps going up, you keep moving your stop up. And I'm telling you something, you do not want to just hold on to this stock, Diana, because this one could very well come back down and make a major correction. Look at that again. This stock could very well pull back to 200 or even more in a 50% retracement of this major move up here. The other thing I'm noticing is that the volumes down here are very, very slim. Look at that. As the stock is going up, the volume is not rallying. It's maintaining very, very low levels compared to the highs back here or even back here. So you can see how the volume is consistently dropping as a whole. That's telling us the buyers are getting tired. Okay, Diana, hopefully that's helped you. All right, some of you, all right, Alan. Okay, Alan, thank you. I caught it. Thank you. IAU. Alan is in at 1269, so it's trading pretty close. This is a monthly chart. Let me get rid of all this now. This is a monthly chart of IAU. This is the gold trust. Now, let's look at this for a second, okay? Again, exercise. Where is, on the weekly chart here, where is the most current role reversal line that we can draw on IAU? Who wants to answer that? First answer gets it. Let's see. I have a price in mind. Can you see my price line on the right side? Okay, who wants to even take? Okay, I got that one. Amalia, all right. Anyone else? On the monthly chart. On the monthly chart, Rick. Yeah, Rick Bolton says on monthly or weekly. Okay, Gil, got that. Robert, got that. Shannon, got it. Joseph, thank you. Brian, oh, you're all very close. Look, I'm looking now. Again, if you're brand new and you still need to develop your eye on this, this should be the most obvious support level here. But remember, role reversal starts with a resistance line. So I actually have to go backwards on the chart to find the most effective or most reliable role reversal. So I have to keep this in mind, but go all the way back until I hit a resistance point right there. So I'm going to draw a line at the top there, right there at the body of that red candle. And there we go. This is a monthly chart. This is a monthly chart, and this is significant. Alan, remember that the monthly chart support level trumps weekly and daily combined. When you can find a major role reversal on a monthly chart, which we have here, and that is right around 1172. So all of you who are around 11 or 12, you're exactly right. That's where we're drawing it. So Alan, that's where I would put my stop, probably around 11.5. So you still have $1 risk per share, even if you were to buy more right now. Now that we have that role reversal, let's go and zoom into the weekly. We're doing 3D charting right here. And what I see is actually a triangle pattern forming here on the weekly. Let me draw that for you. I'm starting to talk more and more about triangle patterns because they're so reliable. You take the highs and connect those, and you take some of the lows and connect those. There's your triangle. Now, this could also be called a pennant. You have a flag here with a little pennant here, a pole here with a pennant. The most significant thing about triangles is that when they break, it could be up or down, the stock usually continues. So let's assume for a moment that the stock breaks down below that triangle. Well, there you have a major role reversal support level right there holding you to defend the position. So I still would wait. If you're thinking about buying this for the first time, I would still wait, but until you see a green candle or breakout. But if you have it, I still think this is a great position. A couple of other patterns pop to mind, but let me show you the second part of this. If it breaks out over the triangle, there's a good chance it'll fight against this resistance around 13.5. Now, Alan, if it breaks over 13.5, you need to move your stop up. So if you have your stop down here, you need to move it up if it breaks out to around 13. So you're going to trail your stop on IAU as well. Okay. Can anyone see another price pattern that pops out on this chart? Can anyone see? I'm going to leave my support level there. Can anyone see a price pattern forming on this chart? Let's see. Anyone see a price pattern? I'm waiting for answers. It's a little delay. Okay. Gil says a channel. I could see that. All right. Who else sees? Okay. I don't see a double top. I see a double bottom. Yes, Michael, I see that. Reverse head and shoulders. Yes, Domingo, I see that too. All right, let's go with all those. Now, the first one I do see is a trading channel. We already have the support level. Here's your resistance area. So it's right in the middle of the channel. So that's a beautiful trading pattern. So again, if you haven't traded this one and it goes to the bottom support level and test, this is a great area between 1170, 1190 to be buying this one. Great, as long as it's pivoting up and see green candles. Perfect, got a good trading channel. Now, I do see a double bottom. Here's a bottom and a bottom, and it looks like that's holding. So double bottoms are very reliable. Now, who was it that said reverse head and shoulders? Let me go back in there. Okay, Domingo, yes. And Joseph, yes. Now let me draw this for you. So in case those of you don't see it, I'll draw the head and shoulders for you. This is the beginning of a head and shoulders pattern. If the stock breaks out of this trading channel and starts going up, here's what it will look like. Shoulder, head, shoulder. The neckline on it is drawn here. There's the neckline at the value. If I was to flip this whole thing as a mirror image, then you'll see a head and shoulders pattern. It'll be very clear. But what I think you should do is a little homework assignment. Google images for reverse head and shoulders bottom. Google that, and you'll see that it compares very closely to what we see right here. So if the stock breaks out and goes over the neckline, or even breaks out over this resistance, this is a huge buy opportunity. So there's a couple of places you can get to buy this, around 1170, 1190, or above 13.5. Or if you're comfortable right now, you can buy it as long as the candle is green tomorrow. I think there's a very good possibility we might even see a bullish engulfing pattern show up pretty soon. Okay. And notice I'm not doing a rapid fire stock analysis. I'm taking a little bit more time because I want to make sure that everyone is getting these concepts and that you're comfortable with the signals. Now, Ron says he's looking at buying KEG and wonder if it's a good entry point. He says he doesn't currently own it. So let's look at KEG, Key Energy Services. Now, remember, we're on a weekly chart. Now, I like this already from what I can see because I see that there's a trading channel right here. Boom. There's an upward trend. And if I was to I could even go back here and do this. And I could do something like that. There's a trading channel. So on the weekly chart, I see a green candle. It's only Monday. So if this stock closes higher Tuesday, Wednesday, or Thursday, there's a bullish engulfing pattern there. That's number one. Number two, on the weekly chart, remember, here is a bearish engulfing pattern. It worked. Bullish engulfing pattern. It worked. Bullish engulfing pattern. Bullish engulfing pattern. They work. You see that? Let me go back and see if I see any more. Any more bullish or bearish. Look at this back here. Look at that bullish engulfing pattern. Beautiful. It worked. Close to a bearish engulfing pattern here. Another bullish engulfing pattern. From what I can see on this chart, on the weekly chart, it looks to me like 100% of the bullish engulfing patterns wound up with the stock rallying. So this is one that everyone on this call should be looking at. In fact, I might even make this as a buy recommendation on the Oracle. If this by Thursday still shows a bullish engulfing pattern, I'm probably going to put that on the watch list. Okay, and this is a cheap stock too, so I've been really liking the cheap stocks because they seem to be performing very well. Okay, so that's KEG, K-E-G, and so again, Ron, I would buy that. And let's finally look at the daily chart. Let's see what that looks like. Yeah, look at that. There's a hammer pattern right off of the 200-day moving average. That is beautiful. That is beautiful. My old friend Dave Elliott, who's since passed from cancer, he used to call that a bull kicker. When you have a bullish sign off of a major moving average, he would call that a bull kicker, and that looks pretty darn good. So I like that one, Ron. Put that one in your position and let me know how that one goes. Okay, let's see. Joseph is in on KKR. KKR. Let's look at that one. Not a very expensive stock. He's bought it at 22. It's trading 23. So he's up about 20%, a little bit more than 20%. That's nice. Excuse me, up around 5% rather. Let's see. We have a bull. Well, yeah, it looks good. So we have a bullish candle. It's not a bullish engulfing pattern. But the reason I say this is a bullish candle is because it's long and it closed above the 200 period moving average on higher volume. That's the key. So, Joseph, let me first ask you, you bought it at 22. Where is your stop? Where'd you put your stop loss order? And again, while I'm waiting for Joseph to answer, this is a great reason to be on these calls, because look, we already have a couple of really good candidates here, one in KEG, and this one looks pretty good as well. It pays to be on these things, and they're free. So, okay, so Joseph said he's got a stop at 2175. 2175 is right around here. So I would use that support level right there. Okay, so you're down below that support level. That's really very good. If this stock breaks out over 23.5 and you see the volume increasing, then I would absolutely add to the position. Now, Joseph, I know this is hard to do because a lot of people are already thinking about getting out, but the professionals will be rallying the stock and adding to the position on those breakouts. And that's a very tough thing to do because you're adding on strength. You're not simply think about selling. And oh, by the way, for the hockey fans out there, I know we have a lot of people from Canada on the line. Rangers just ended the first period 2-1 against the Canadians, Montreal Canadiens. So I'm a Ranger fan. So sorry if you're rooting for Montreal. But that's the score at the end of the first period. We should have enough time to go watch the rest of the game after this as well. Okay, so let's get some more stocks. All right, now let's last 6 minutes. I'm going to blast. I'm just going to blast the rapid fire stock analysis segment here. Let's go. Who wants to type in a stock symbol? Okay, Gloria says catamaran. What's the ticker symbol on that one, Gloria? Do you know? I don't know the company and I don't know the stock symbol. If you can't, put that in there and I'll look for you. Okay, Brian, Lulu. All right, I'm going to use a daily chart, LU. All right, LU, Lulu. If you don't have it, I would consider buying it, mainly because it's dropped so far below the 200 period moving average here. See the divergence? And you have a good strong green candle. It looks like a double bottom forming. I would put my stop below 42. This one looks good on a buy on the divergence. If my target price would be somewhere up here, maybe to fill this gap because the gap wasn't completely filled. So my target price would be around 57 on that one. Okay, next one, MA. Edvaldo, MA. Looking for a position. I don't see if you have a position in that one. That one also looks good. MasterCard looks good. This I would keep a very, very tight stop. I would keep the stop right around 71 because if it breaks down below the 200 period moving average, it's game over for this one. So be very careful. It's not the best looking stock, but it does look like it's holding its trend line here. Okay, that's the weekly chart. So remember, keep your stop tight on that one and make sure you do put a stop. UPS, Sheldon, hopefully everyone's taking notes on this. UPS, I'm on the weekly chart. Weekly chart is telling me it's getting a little tired, mainly because I see on the weekly chart you have a long shadow above the candle. Long shadows above the candle generally tell us sellers are starting to come in. So be very, very careful, Sheldon. I don't know what your position is on that one. Let's look at the daily chart. Yeah, here's your roll reversal. So if you buy this one, I would put my stop right below 100 and leave it. I wouldn't try to get back in unless it bounces off of the 200 period moving in. So UPS still looks like a buy with the stop below, I would say below 99. All right, Ron says CGIX. If you have a position in this one, let me know. Right now we're just looking at stock. CGIX looks really strong on a divergence bounce. It looks like it had really bad news, but look what's happening. The volume is dropping down here. The volume is dropping, telling us the sellers are tired. That's a daily chart. If you buy this one, it's still a cheap stock. I would buy it with the target price around $14.55. This stock could very easily go back up to the 200 period moving average and fail, which happens to be that roll reversal resistance back here. This could be the kiss of death, actually, for what I call a kiss of death when a stock tries to move back over the 200 period moving average and fails. So right now, if you own it or think about buying it, you would buy it, put your stop right below, I would say put your stop at $8, put a $2.35 risk per share on that one, and move on. Okay. Okay, Ken, I'm so sorry. I don't have Canadian stocks on this platform, so I'm not going to be able to go to ptk.v. CTRX I can look at, though. CTRX is coming from Gloria, and thank you for that. Gloria is, okay. This is a tough one. Gloria, this is really a tough one because it's caught between two gaps. You see that? It's a gap to the upside and a gap to the downside, and the 200 period moving average looks like it's going lower. This is a very, very tough one because it could go either way. It's kind of like a coin flip. Now, I have to go to a weekly chart to really look at this one. Oh, no, I don't like this one at all, Gloria. This is a rounding top. This is a very bearish, longer-term position. A rounding top, like rounding bottoms, are very, very accurate. This one looks like it's going down and could very well. Gloria, again, I don't know if you own this stock, but this one could very well wind up at a roll reversal support right around 33. So watch out for that one. Johnson & Johnson, I'm looking at the clock. We got 1 minute. J&J. J&J still looks pretty good on the weekly chart because how many of you caught the bullish engulfing pattern back here? The only thing I don't like is the stock is going up on the weekly chart. I don't know if you see this, Robert, but the volume is dropping. So you have a price volume divergence. On that note alone, I would stay away from this one. Even with the bullish engulfing pattern at the top, I would stay away because of the dramatic drop in volume. I'm not even counting today's volume because it's only the beginning of the week. But this is very consistent drop in volume. I've run out of time. I haven't run out of stocks because you're still giving them to me. And I definitely have not run out of excitement. I love this. The markets are looking really good. And by the way, we're coming into the summer months, which for a lot of people, a lot of people have a hard time coming up with ideas or strategies. We do have a couple of openings opening up soon for the mentoring service. If you're interested in that, just send me an email. I'll tell you more about that one-on-one coaching service that we offer. And we could help you through the tough trading months of summer. If you're, again, brand new to the market, guys, and you would like to look into the Oracle service, that's our trade alert service, go right ahead. You can click on the shop button right there, and you could look at our Oracle service. If you're already an Oracle subscriber, then congratulations, because we have had some really good trades, and the best is yet to come. I'm really excited about 2014, and we're just getting warmed up here. We just ended the first quarter. We still have almost a full 3 quarters to go. So thank you, everybody, for joining us, and I look forward to our next one. Have a great night. Go Rangers. Bye-bye.